Again, reintroducing myself, Melvin in Nabuife. As I was saying, our goal today is to welcome you to the world of investing. My goal is to walk you through the basics of growing your wealth, from understanding different investment types to understanding and how to avoid the common pitfalls that come with investing. So, why are we investing? Why is investing an important item for us? Well, the first thing and the biggest power from investing is the power of compound interest, right? The ability for your money to multiply by itself as it grows over time and by the amount of growth that it's getting year over year. So, watching your money grow exponentially over time, that simply tells you that the earlier you start, the better and more powerful the effect is on you. Now, the second thing, and in today's climate, I think it's very important that we mention it because when we talk about investing, for most people, they actually don't realize that this is one of the most important reasons to do so. All right. But one of those really most important items is to secure your assets against inflation. Why is that important? The growth of stocks actually help keep your money or help your money hedge against the eroding effect of inflation. That is, the eroding effect of inflation on the power of each of your dollars. So, inflation is one of those things where the higher it is, the less powerful each of your dollars is. That's the simplest way I can put it. So, you want your money growing ahead of the rate of inflation at any given time. Well, the best hedge against that so far has been making sure you have a diversified portfolio that's growing ahead of that inflation. And the last thing, and most obvious but most important, is your future security, right? Building a financial safety net in investing creates a stable foundation for your long-term goals. So, again, the importance of this is being able to create stability for yourself as you look ahead, helping you stay ahead of inflation, right? Making sure the power of your dollar stays in over time. And then most importantly, making sure you're tapping into the power of compound interest. That is that is the big magic item when it comes to investing. Now, what are some types of investments? Now, for the purpose of today's conversation, we're speaking to investing primarily through the stock market or any other various forms of commodities. So, securities or commodities. But for today's purposes, we're really looking at securities. We're really looking at being able to build wealth through the stock market over an extended period of time and the impact that will have on your finances through that time. So, what are stocks? Stocks are units of investment in a company. They're units of ownership of a company. All right. So when you buy a stock, a single stock, you have just bought a piece of a company. Right. So the transaction you just completed, it's backed by the underlying value of the company that it represents. This is why the company's economic activity reflects on the stock. Other things reflect on the stock, and we'll talk about this as we go forward. The second type of investment or security in this case is bonds. Now, bonds are debt tools. All right? They're methods of raising capital or raising funds by selling debt. Right? You're lending money to a government or a company, and that company is saying in exchange for that, our economic activity as a result of this money you've given us is going to generate returns down the line that when the bond comes due, you're going to benefit from that, as well as other parts of the bond that you're able to benefit from. Now, the These two items, stocks and bonds, really make up the core of your investing vehicles. Now, how you access that is how we now start to come into things like mutual funds and ETFs. A mutual fund is a diversified mix of stocks or bonds, and bonds, and typically professionally managed by a fund manager. Right? So, what you're doing in this case is you're saying, "Hey, I want to access a variety of, excuse me, I want to access a variety of stocks or bonds and bonds, but I want to make sure that I'm spread out enough that I'm not taking on the full risk of a single company or single bond." So, in order to do that, these are the ways you actually access that. You access that by buying a single item that owns pieces of multiple items. Okay? So a mutual fund is a diversified mix of stocks and bonds. The key differentiator here between it and an ETF, though, is the mutual fund is actually professionally managed by fund manager. So typically there are increased costs associated with it, and performance is more related to the fund manager themselves rather than the securities or the benchmarks that they're giving themselves. Now, ETFs are very, very similar to mutual funds in that it's a diversified basket of stocks and bonds. But it's typically attached to a particular index or a particular theme or flavor or whatever. And it has a benchmark that it's using to keep itself in line with its goals. These are complicated, but again, this is why it's important for you to speak with a financial professional who can walk you through what these things are and what they mean and the impact on your financial future. Ooh, it's hot in my office. Give me 1 second. Let's turn on this fan. All right. Sorry, I don't want to be looking like a Christmas goat in front of you guys. All right. So next up we have balancing risk and reward. So now that we know that the stock market in its various forms, or at least the securities industry in its various forms, is the most reliable way of growing your investments or growing your assets over a long-term period. Again, in a diversified form, this does not negate things like insurance. It does not negate things like real estate. This is just one form of investing that plays a role in your overall game plan. And again, actually, that relates to this slide, right? In balancing out what your risk reward is, that is how you decide how much of your assets are allocated towards your real estate goals, how much of it is allocated towards your retirement goals, how much of it is allocated towards your more short-term and immediate goals, and then lastly, how much of it is play money, right? How much of it are you just willing to risk on more outlandish ideas, right? All of these things, you're really able to decide them by making sure you're starting with a game plan before looking for return. You don't get return and then have a game plan, right? You don't get the money and then you have a game plan. No, you have a plan so that when the money comes, when the growth happens, you know what to do with it. So low risk, low reward investments are stable investments like bonds. They have slower growth. It's more predictable, but over time, there's less volatility. There's less up and downs in your assets, right? You have moderate risk, moderate reward type investments, and this is more of a balanced approach, a mix of stocks and bonds. You want some of the long-term growth that comes with stocks, but at the same time, you want bonds for the stability it provides in today's market, right? Now, the third way you can look at things is high risk, high reward, right? Aggressive investments in things like stocks, which of course have significantly greater potential for growth, but come with exceptionally higher volatility. It comes with more risk. It comes with more more up and downs in the numbers that you see as far as what the current value is. So you have to then decide, first of all, what is my goal? What am I actually trying to get done here? Right? What is the reason I'm investing? Am I just trying to make money? Am I investing because my daughter is great at jujitsu and I want to make sure that no matter what happens, she's taken care of down the line? Am I investing because my parents never invested and I want to change that for my lineage? There's a variety of different reasons why you're investing. And all those different reasons will help you decide the appropriate asset allocation, the appropriate level of risk to take, but also how long out your time horizon is. How long out do I need this money for? So the first thing, typically in creating a balanced portfolio, especially for a young investor, for a newer investor, start with low cost index funds. Start with things like something like an ETF, right? An ETF that's a broad market ETF, whether it's an S&P 500 ETF or just a global market ETF, start with a broad market ETF that exposes you to the whole market, but then it's minimizing your fees because you're doing it through, again, a low cost index fund. All right? Don't start with trying to get fancy. Don't start with trying to do 1,000 different things. Start with something low cost, something you can easily understand, and something you can easily keep an eye on, although you don't want to feel like you're getting in there and putting your hand in there. We're going to talk about this in a little bit. You want something that easily gets you access to what the broad market is doing for you. Now, as your experience grows, as your understanding grows, as your goals grow, you can start to add things like individual stocks or real estate, right? Now you're looking at a diversified portfolio beyond just the stock market, right? In the last class, I talked about your portfolio being not just your investment portfolio, but think about it as you yourself, you're an asset, right? Your liquid portfolio, so your monies, your hard portfolio. So when you think about yourself, right, how do you want to make sure you're hedging your risk when it comes to yourself? By staying ahead with your certifications and your knowledge, right? By making sure you're not lagging behind your peers when it comes to your career or the level of knowledge you have, right? When it comes to your real estate and things like that, how do you make sure you're staying ahead? By doing your due diligence before you purchase real estate, right? If you're a real estate investor, by understanding what kind of strategy you're looking to implement before you take that path, right? And the same thing is going to be said for your stock market investments. So again, the purpose of today is not to make you think of only the stock market as an investment vehicle, but for you to understand that it plays a role in the overall game planning that you're doing. Now, lastly is maintenance, right? Regularly review and rebalance your portfolio to keep your portfolio aligned with your goals. Again, if you don't have goals that are aligned with what you're doing, you're just throwing potatoes at the wall or throwing tomatoes at the wall and seeing what sticks. All right? You need to have a goal that helps you create what your plan is. And then based on that, you're able to benchmark yourself. You're able to keep yourself accountable over an extended period of time. Now, time in the market matters. If you're young now, start as soon as possible taking advantage of an exposure to the stock market. I see so much on social media, on YouTube, on so many places that people talk about the 401k is useless or this or that, and I don't understand it because, well, I do understand it, right? Social media and all these things have made us think about exciting versions of investing, and crypto has its own part to playing in that in terms of the idea of what realistic returns look like in a short-term period. But the reality is, if you don't start, none of that matters. So start early. And then again, this goes back to having a game plan. When you start early with a game plan, it'll help you stay consistent, right? This is why it's great to do it through a 401k. You're working, you're doing your daily. Let that money just go in monthly. Let that money just go in monthly. Max out your 401k. Max out your Roth 401k if you have access to that. Max out these tools, but then don't just max it out, but discuss with the financial professional to make sure it's allocated appropriately, not just in relation to itself, but in relation to your overall financial plan and investment plan. And then lastly, ride out volatility. Markets fluctuate, but historically they trend upwards. Patience is key to long-term success. 7 out of 10 times the stock market is in a positive trajectory, right? More often than not, it is easier for you to miss those good times than for you to time it properly. And this is why we talk about what we talk about next, right? The cost of timing the market. I want to take a second on this part because it's very, very important. So many people on social media keep on telling you, do this fancy thing, do that fancy thing. So many people on social media keep on trying to predict a recession or predict inflation. Or all these things are various forms of trying to time the market. It doesn't work. On this diagram here, what you see is the cost of timing the market. So you see, missing the best 60 days in the market, investment returns are 93% lower if the 60 best days are missed. Just 60 days in the history of the market. Just 60 days. 93%. Right? If you miss the 50 best days, look at the impact. Now this is missing just the 30 best days. And this is something very great. In 2020, the second best day happened immediately after the second worst day. The year after the Great Depression is, I believe, if my knowledge is correct, is the best year in the stock market history. If I'm correct, I'll do my research and I'll put it. I'm pretty sure it's 146% return. But I mean, wow, the year after the Great Depression, that's why so much wealth was made post-Great Depression. Right? 7 of the 10 best days took place in bear markets. And look at the impact to your dollar if you were consistently invested on all days. Look at missing just the 10 best days and look at being invested straight through. It's impossible for you not to see the value of one, compound investing, or 2, of spending time in the market rather than trying to time the market. So we know what the current climate looks like. We know how difficult things are for every one of us here today, and I believe your budget shouldn't stop you from starting. Right? With investing and with financial planning as a whole, it's a question of building habits first. Right? So start small. Start with what you can afford. $20, cool. $50, cool. I'll tell you something. When I started with Acorns. I used to do, I don't know if you guys know the Acorns app, but I used to use it. I started when I was in college as an immigrant, right? I used to do $20 a week as an immigrant earning minimum wage in college. 20 hours a week. If you're an international student, or if you were an international student, you can attest to what life was like in college. But you start small and you build little by little, right? And then you continually adjust. As your status adjusts, as your plan adjusts, you adjust as well. Take advantage of apps that round up purchases and invest the spare change. I know Cash App does it. I know, of course, Acorns does it. There's a lot of apps that round it up. What are you doing with that money? Okay? And at the end of the day, it's still your money. You're just investing in your future self. And then last but not the least, if you can, automate as much as possible as far as your savings are concerned. Automate your savings as much as possible. All right? Treat it like something that you don't even want to see hit your account. You don't even want to see it before it hits you. Let it go straight in there. It doesn't count. It's future use money. Watch how quickly your money grows. And I'll tell you, you make your first 100,000, getting to 1 million is significantly easier. What do I mean by that? The more your money grows, the easier it is to get to the next level. Now, what are the most important essentials in investment planning that you have to do? What are the steps you take? Well, first of all, you must define clear, measurable financial objectives. Two things are there: clear and measurable. That is, I understand what my goal is, and I can keep track and hold myself accountable of this. Okay? That will allow you to understand what your time horizon is. How long do I have to think about this money? If you're retiring at 65 and you're 40 years old today, your time horizon is not from 40 to 65. That's a goal within your plan, but your time horizon is how long this money has to last for you, even after retirement, when you start depending on the money. So your time horizon, as a result of the goals you have for that money, help you understand how much risk you can take on with those dollars. And when you have all these things planned, whether you decide to do it by yourself or you sit down with a financial professional, the conversation is going to be that much more productive. And the plan generated for you is going to be that much more productive. Now, what are some common pitfalls that you should avoid? First things first, please, please, please. I know it's very easy. Social media is such a great influencer, but avoid chasing trends. If your friend says this is happening or this is happening, if there is not real due diligence to support that claim, brother, avoid it. Don't overreact to market volatility. When you see the market going crazy, remember that chart I just showed you. Remember that time in the market far exceeds timing the market. Make sure you have a diversified portfolio. Don't say, oh, because I hear AI is all over the place and everybody's talking about AI, I'm going to put all my money in only AI companies. Don't do that. Don't be that person. Don't say because, oh, I see everybody's buying real estate, everybody's buying a house, I'm going to go. Don't be that person. Look at your portfolio, look at your goals, and assess how much of your money needs to be allocated to the different areas. Lastly, and this is something I see a lot, is ignoring fees. A lot of people tend to ignore the cost of actually investing. And I believe that actually has a major impact on your portfolio. So even with hiring a financial professional, make sure that the individual you're hiring is cost effective to your goals. Alrighty, so last but not the least, folks, take action. All right, choose a platform, choose a vehicle, but start with an amount you're comfortable with investing. But the key thing is start. All right, keep learning. Use this as the guideline to get out there. Learn. All right? Learn more about this. Learn more about it. Take more control of it. And then lastly, continually look forward. Remember, investing is a long-term game. Stay focused on your goals. Stay focused on future you, and that this is for them. And like I said, if you have any questions, if you're interested in sitting down and evaluating your financial plan, don't hesitate to reach out to me through our Facebook page, the Bogle, the Tampa Bay Black-owned business list page, or our Instagram or YouTube. We're happy to schedule conversations through our Calendly platform as well. And certainly that first conversation comes without a cost. So let's have a conversation and really get to understand what your plan is and how to execute it for you. Folks, it's been a pleasure. Thank you so much for the time. It's been your host, Melvin Nabuife, and I look forward to seeing you next week for Wealth Wednesdays. Cheers.